Welcome to the Due Diligence Podcast. I'm your host, Robert Kraft, and for more than 10 years with SNN, I've been doing interviews with MicroCap management teams at investor conferences globally as well as online. Our SNN Live CEO video interviews are meant to pique interest, and then one can discover more by going to that company website. But personally, I always have more questions I want to ask. On this show, I'll be chatting with public company executives from microcap companies, and we'll dive deeper into companies that are rarely profiled. Microcap traditionally is overlooked, unloved, and absolutely never featured on legacy financial media outlets unless something material is going on. That's a good story. With my experience interviewing management teams, having interviewed most of them before, I've built up a network of companies, so there will be no shortage of content. Furthermore, this is an opportunity for me to showcase some of the qualitative lessons I've learned from guests on the Planet Microcap podcast. You can expect high-quality interviews with management teams that may have exposure to broader macro trends that you may never have thought of. One of the many reasons why I love the microcap space. So if you love microcaps and especially love learning about companies before the professionals do, let's start our due diligence. This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast. My guest on the show today is Doug Gaylor, President and COO of Crescendo, Inc., publicly traded company. The symbol is CXDO on NASDAQ. The company is a provider of unified communications as a service, UCaaS, call center as a service, CCaaS, communication platform software solutions, and collaboration services designed to provide enterprise-class cloud communication solutions to any size business through their business partners, agents, and direct channels. Crescendo's solutions currently support over 2 million end users globally and was recently recognized as the fastest growing UCaaS platform in the United States. Crescendo has been written up in some microcap newsletters I respect, and Doug did an interview with Maj Soueidan on one of our pods a while back. And I wanted to invite Doug to join me for this conversation to discuss where he sees the company in 3 to 5 years, the inflection points that will get them to that point, and how COVID impacted Crescendo. With that, please enjoy my conversation with Doug Gaylor, President and COO of Crescendo, Inc. Welcome to the Due Diligence Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BLBBYKKRAFT. And joining me right now is Doug Gaylor. He is the President and COO of Crescendo, Inc. It's a publicly traded company. The symbol is CXDO on NASDAQ. Doug, thank you for joining me today. How are you doing?
Thanks, Robert. Doing great. Thanks for having me on the show.
It's great to have you on. So last time we met vis-a-vis Maj Soueidan from Geo Investing. I believe you were a guest on one of the pods that we did for that show. And look, I wanted to have you back because that was a great episode, and I wanted to give you dig in a little deeper even since then. But to start us off, this is how we start every podcast here for due diligence. Is how would you describe Crescendo in that one sentence, that one-liner?
Yeah, so Crescendo is basically a cloud-based hosted phone services for small, mid-sized, and enterprise-level businesses. So we basically provide business phone services over the internet that we host on the cloud, and that's really the way everything is going now, is everything's on the cloud. And so that migration from older premise-based equipment to the cloud is basically where we sit.
Very good. So can you provide us an overview and history of the company? What was the original problem Crescendo was looking to solve, and how has that evolved or changed over time? You kind of already alluded to it a little bit. I don't think the cloud was around back in the early 2000s. So love to hear your answer here.
Yeah, so if you think about it, back when I first started with Crescendo, which was 2009, 2010, we didn't even have a product yet. We were building it behind the scenes, but back then in the mid to late 2000s, every business out there has got a phone system, and 98% of them were using premise-based phone systems, the old Avayas and the AT&Ts and the Toshibas and the Mitels and the Intertels of the world. And so they all required a box that was in their office, and everything was premise based. And as we well know, the cloud has really taken over, most technology oriented industries, including ours. And so it was really a revolutionary time. The late 2000s, early 2010s is really when cloud communication started picking up steam, because at that point you had enough bandwidth in your office to be able to transmit all of your voice calls over your internet connection. And so really what we did is we took the old PBX and we took it out of the office and we put it on the cloud, and we now host businesses' phone systems on the cloud. And so it's much more reliant, much more efficient, much more productive. And so it's really a revolutionary change. I kind of alluded to, the old cell phone is that, if you think about everybody having a flip phone back in the early 2000s before smartphones came out, those were the greatest things since sliced bread until you saw the smartphone. And then it was like, boy, I got to have this. And the smartphone revolutionized the way the mobile industry works. And cloud communications really has revolutionized the way business telephone services work.
Absolutely. So, you joined the company back in 2009. What would you say originally attracted you to Crescendo? And how is that original thesis for joining change or that evolve over time?
Yeah, it's really been a great story. I've been in the telecom industry for 35 years now, so dating myself a little bit there. But the first 20 years was with a company called Intertel, and Intertel was a publicly held company that grew to $500 million. We were listed on the NASDAQ, and an extremely successful organization. And Intertel got acquired by Mitel in 2008, and I stayed on. I was senior vice president with Intertel, and I stayed on with Mitel for 2 years after the acquisition happened. And around 2010, 2009, Steve Mahalo, who was the original founder of Intertel and grew that to a $500 million company before the sale of the company, called me up and said, hey, everything's moving to the cloud, and Mitel is not pointed in the right direction for the telecom industry, and I'm going to start up a new company and bootstrap it with telecom services on the cloud, and come help me run it. And so I had a great working relationship with Steve for 23 years at Intertel and Mitel. And so I took that opportunity. And as I said a moment ago, we didn't even have a product. We brought a lot of the engineers over from our former company, Intertel, and started building our own cloud-based solution. We put our first customers on it in 2012. So it was really the opportunity to start from the ground level and build something pretty spectacular. And so to go from the ground level of no customers on our cloud to today having over 2.5 million customers using our platform is pretty significant.
What about cloud technology? When you first joined up, you heard Steve, you're like, okay, all right, let's do this. Sounds interesting. It seems like everything is now going to the cloud. Mitel doesn't want to even go down that road right now. But what about the cloud technology and cloud communications since then, would you say surprised you the most? And what about that opportunity even then where you're like, okay, they're making a big mistake not doing this?
Yeah, I think it was the slow adoption to move business aspects to the cloud. So, when we think about, again, the cell phone analogy, everybody's got a cell phone. And so it was easy for customers to move to a smartphone. Businesses don't move as quickly. And so businesses were a little bit more fearful of moving their premise-based box that was back in the equipment room that they always knew where the box was to moving it to the cloud. So, if you think about the early 2000s or late 2000s, 2010 timeframe, customers were a little standoffish on moving to the cloud because what happens if the cloud goes down? Now with redundancies and resiliencies, that's not a worry. But, in the early stages, it was what happens if the cloud goes down. The cloud never goes down, but a portion of the cloud may go down. If your internet connection went down, and back in the 2010 timeframe, internet connections weren't as strong and reliable as they are today. So that was a little bit of a worry. And I think, if you think about businesses back then, early iterations of the cloud, were lacking maybe some of the features that customers were maybe used to on their traditional premise-based systems. But now the cloud has more feature functionality than any premise-based system out there. But in the early stages, just like any technology, it had to come up to speed. And so, the early adopters, were ones that they weren't really trendsetters, but they were the first ones to realize that the cloud was more productive, more efficient. Gave them mobile capabilities, gave them work from anywhere capabilities, and most importantly, it usually saved them money from what they were paying for their traditional older premise-based equipment.
Doug, I don't mean to call you out right now, but I'm going to do this, and hopefully it's in a funny way. I haven't heard UCaaS once. The unified communications as a service. I mean, come on, it's on a platter for you in the company description and everything. So I'm curious. I find that kind of interesting that you haven't used that phrase just yet.
Yeah, it's interesting because I think being in the industry, we use acronyms a lot, and UCaaS is kind of the acronym for our industry. But when I tell people that I'm in the UCaaS industry, they're like, what is that? So UCaaS is Unified Communications as a Service, and basically that's just the acronym that we use for cloud communication. But when I talk about my business and when I talk about what we do out there, I usually try and put it in layman's terms, because when we talk about acronyms and we start using UCaaS and CCaaS and CPaaS, there's a lot of not to joke, but a lot of asses out there, and so. So, when you think about all these as a service type offerings, I think the acronyms have really gotten a little bit out of hand. And so I try to just bring it back down to reality that, hey, it's business phone services. Every business out there has got a phone system, and most of them are going to benefit from being on the cloud. And it's not a matter of if these businesses move to the cloud, it's when. If you look at the statistics, there's still 60% of the businesses in the U.S. that haven't moved to the cloud yet. Means that only 40% are utilizing the cloud today. And it's not a matter of if that 60% moves to the cloud, it's a matter of when. And if you look at Gartner's reports out there, it shows that, the industry is growing rapidly and continuing to migrate. So within the next 4 or 5 years, that number will be down probably in the single digits of people that are still not on the cloud. So, again, in 3 or 4 more years, when we have this conversation, 95% of the businesses will be on the cloud. And at that point, it's moving customers from one cloud provider to another. So I'm going to take a customer from RingCentral or Vonage and move them to Crescendo. So you're going to see more of that. Right now, most of the migration today are the people that have the older legacy premise-based equipment moving to the UCaaS environment.
And so is that your primary target right now, rather than converting, people who are already on the cloud, or are you doing a mix of both?
Yeah, doing a mix of both. So, I mean, obviously, it's probably the lower hanging fruit are the folks that haven't moved to the cloud yet, because they're going to take advantage of a lot of technology. The folks that are already on the cloud, at that point, it becomes, hey, I'm not happy with my existing service provider, or my prices are too high. So it's that's really more of a seamless migration to move from one cloud provider to another. So it's similar in the mobile industry to moving from T-Mobile to Verizon. With your iPhone, you take it in, they swap out the SIM card, and you're good to go. As opposed to if you had an older flip phone and moving to a smartphone, that's a much more challenging move.
Sure.
You can still do it, but that's really what we're going after. We're going after all those people that still have the flip phones out there. And again, at 60% of the market, that's still a pretty big piece of the pie that's still left to eat.
Sure. And what would you say makes Crescendo's offerings unique and different compared to some, the Vonages, the RingCentrals out there?
Yes, I think our unique proposition is that one, we are in control of our own platform. So we make our own platform. So again, we're the fastest growing UCaaS platform provider in the country today, and that was based on Frost & Sullivan's report that came out midpoint of last year. So the fastest growing UCaaS platform provider, servicing over 2.5 million end users here in the United States. That's a pretty significant statement. So what our biggest advantage is that, one, we make our own platform. So our engineers and our design staff, they're the ones responsible for talking to our customers and finding out, hey, what do you need? Because we take a lot of that customer feedback and roll it out into our new releases. Organizations like Vonage uses 2 platforms. They use Cisco's BroadSoft platform, and then they have their own platform. So they've got about half their customers on BroadSoft's platform. They don't own that platform. Cisco owns that platform. So they're using somebody else's platform. They don't have control of that platform. So that's why they, over the last couple of years, have migrated to their own platform. they still have a pretty good mix of half of them on Cisco's platform, half of them on their own platform. When we look at us compared to our other big competitors like an 8x8 or a Ring Central, I think we package more feature functionality into a package without the extra nickels and dimes that, oh, you want that feature, that's extra. You want that feature, that's extra. So I think we've got a very nice package. I think we also differentiate ourselves by the hand-holding that we do from a customer service and support perspective. I like to talk about the fact that when the customer decides to go with Crescendo and they put their solution in, it's plug and play. And when I say that, that means that they plug in their phone and they start talking. With our competition, I like to joke that with our competition, it's more plug and pray. You plug it in and you pray that it works because in many cases, they didn't do the right due diligence to set up all the things behind the scenes. So we spend a little bit extra time doing that hand-holding to make sure it's a nice, smooth transition for the customer.
But when you're competing with some of these larger customers that have a bit more of that brand name, what's been the strategy for that customer acquisition? Despite going in and saying, look, our value prop is that we have better solutions, better product, better UCaaS, the whole bit. But you still have to overcome that brand recognition, right? In some cases. So how do you do that? Are you going in at lower price and then just capture that client because you see the long-term relationship value? Love to hear your thoughts there.
Yeah, a little bit of both. So I think if you look at it, we've got two sides of the equation when we talk about our sales approach. We've got a direct sales approach where we sell directly to end users, and then we sell our platform offering to other UCaaS providers where they're going out and selling to the end user. So we've got two different sales approaches. When we're selling to an end user out there, our approach is one, get to them first, because if we get to them first and we educate them on the benefits of cloud and UCaaS and all the feature functionality and can show them cost savings, in many cases, it's not even a competitive situation. If I go to somebody that's got a 10-year-old Avaya system and I show them the benefits of the cloud and their cost savings, in many cases, they're signing up right on the spot because they were just unaware of, wow, that's great technology. I need to be able to take advantage of that. And so when we look at that type sales approach, it's getting to them first and then highlighting all of the benefits that the system's got. When we talk about the other side of the equation, we acquired a company last year called NetSapiens. With NetSapiens, we bought a platform offering out there. That platform offering has got over 200 UCaaS providers using that as their system of choice for their end users. And so the platform side of the house competes against the Microsofts and the Ciscos. Microsoft and Cisco have the number 2 and the number 1 respective platforms out there. Cisco owns BroadSoft and Microsoft owns Metaswitch. And so we're going out there and providing a platform to UCaaS providers out there. And we're just seeing tremendous need and desire for our platform out there. Tremendous cost savings over Cisco and BroadSoft. We've got a really unique proposition when it comes to our platform in that we sell it based on sessions, not seats. Where Cisco and Microsoft are very seat-based, that means that they're charging you a license fee for every single end user that you've got on the platform. So if you've got 10,000 desktops on your BroadSoft platform from Cisco or your Metaswitch platform from Microsoft, you're paying a seat license for each and every one of those 10,000 end users. With our Crescendo platform, we charge by the session, not the seat. So you could have 10,000 seats out there on our platform, but the reality is you're not having 10,000 people on the phone at any given time. In the reality of business world today, you might have a 10-to-1 ratio. So you don't need 10,000 licenses. You may only need 1,000 sessions to support those 10,000 licenses. So we sell on a session basis, not a seat basis. And that's very revolutionary. So that really took the industry by storm. That's why we're the fastest growing platform out there, because Cisco and Microsoft continue to nickel and dime on every seat license out there, where we say, hey, you can have as many sessions, as many seats as you want. You're only going to pay for concurrent sessions. And that allows you to manage your business a lot better.
So how are you seeing the conversion rates? Because let's talk specifically to going to the folks that are using the Microsoft, the Cisco, and then converting over to Crescendo. How fast, slow? What does that rate look like?
Yeah, so if you look at our 200 plus UCaaS providers out there, some of them started from scratch with our Crescendo platform and built their business around that. Others have migrated from Cisco or from Microsoft. That's a little bit more of a slow transition. So we call that a cap and grow type migration. Somebody's got a BroadSoft platform today that wants to migrate to Crescendo's platform. Will cap their BroadSoft Cisco solution, meaning they're not going to continue to add to it. And then they'll put our Crescendo solution in, and over time migrate their customers over from one platform to another. So that's a very, very, not time consuming, but it's a very planned out type transition. So they cap their growth with Cisco, they put in the Crescendo platform, they start building the Crescendo platform, start migrating their customers over. If you look at what it costs to support a Cisco solution or a Microsoft solution, it's very expensive. And so for most of those resellers out there, if they're in a position to look at their cost and say, hey, it makes more sense for us to go to a Crescendo solution long term, they'll put our solution in and start growing that over time. If you look at Cisco's BroadSoft solution is in some of the largest providers out there. So the Verizons, the CenturyLinks, the cable companies out there, they all are large BroadSoft Cisco providers. It's hard for them to move that large of a platform over to Crescendo. We'd love them to, and we're pursuing those opportunities, but that just takes a lot longer. A lot of the smaller BroadSoft players, it's easier for them. So somebody that's got 10,000, 15, 20,000 desktops, easier for them to migrate over to a Crescendo than a Verizon or Lumen that might have, millions of stations on their BroadSoft platform.
Got it. And despite the companies having this fast growing title, which is great, what do some investors, when they're doing these interviews with you and one-on-ones, they're chatting with you, they're probably like, all right, there's probably some kind of like, why aren't they, you get it probably all the time, like, why aren't they moving faster? Why aren't they doing this? Like, there's clearly the value prop. Like, what do you have to do to get there? I'm sure you get that all the time.
Yeah, I like to highlight that we're the best kept secret in the UCaaS. So not a lot of people know about us. So that's the great thing about doing these type of interviews is getting out there. So the fact that we're on a $36 million run rate right now based off of our Q4 financials. So we finished Q4 with $9 million worth of revenue in Q4. So that's a $36 million run rate. We were finished 2020 on a standalone basis at $16 million. So you look at that run rate now, and we've more than doubled in size in 1 year. If you look at where we are growth-wise, organic growth is north of 20%. So when we look at where we are today, we're growing rapidly. But as I said, we're probably the best kept secret out there because a lot of investors don't know who Crescendo is. We uplisted to the NASDAQ in 2020, and so that was a great uplist for us, but it was an organic uplist, so we didn't go out and dilute or raise a lot of cash in doing that uplist. It was an organic uplist. We got a lot of fanfare out of that, but again, we're a small microcap company that as people hear about us and they start seeing our growth trajectories, the biggest thing for me is where we are today at $36 million run rate is just the beginning. I mentioned our previous company, Intertel. So Steve Mahalo is our CEO. I've been working with Steve for 34 years now. And so at Intertel, we did a lot of acquisitions of our Intertel resellers over the years. With the NetSapiens acquisition that we did last year, we've got 200 UCaaS providers using our platform today, and I call that my stocked fishing pond. Now I've got 200 resellers out there that prior to the NetSapiens acquisition, an acquisition for me might be a BroadSoft reseller or a Microsoft reseller or an Asterisk reseller or somebody that's using somebody else's platform. That takes a lot of migration. Now I've got 200 UCaaS providers out there that are all using my platform. If I choose to acquire any of them, it's a very seamless migration and it's a very synergistic migration because now I can buy these folks. They're already using my platform. I don't have to change anything with their end user customers. They're already on my platform, and I can eliminate some overhead costs in the additional customer service and support aspects. I can eliminate the licensing costs that they're currently paying to us. So it's a very accretive acquisition strategy. So if we look at where we are today at a $36 million run rate, we estimate that the total revenue stream out of those 200 plus resellers that we've got selling our platform today, we estimate the revenue stream on that's about $350 to $400 million. So we've got resellers there that range from $2 million in annual revenue to $50 million in annual revenue. So if we can go out there and look at that stock fishing pond and pull a couple of fish out each year, we can see our growth rate grow pretty incrementally and pretty steadily. So our goal is to get this thing from a $36 million run rate to a $100 million run rate in a couple of years. And we'll do that through organic growth of 20 to 30% and acquisition growth out of our stock fishing pond.
Very good. So just one more question, looking at the competitive landscape. I mean, what are some of the bigger players when, a client is considering either Crescendo or an 8x8 or RingCentral, or one of these? What are they you hearing that they're saying about Crescendo? Is it just like, there's smaller platform, smaller company, like why go to them versus where, we've been around for a while? Like, is that kind of the main pushback?
Yeah, I think, again, when I think about RingCentral and 8x8, both the, multi-billion-dollar organizations. And so, they look at Crescendo as a little guy out there. But, our resume speaks for itself now, again, being the fastest growing UCaaS platform provider in the country and 2.5 million end users on our platform. 2.5 million end users is more than 8x8's got on their platform. So, in theory, we're larger than 8x8. But again, most of those customers today are going through our resellers, so we just get a small sliver of that. So again, if we think about what that total revenue stream is out of that total customer base that we've got out there, it's pretty significant. We don't recognize just but a fraction of that, but over time, with the right acquisition strategy, we're really a force to be reckoned with. And I think that the competition realizes that in the fact that it's a very easy acquisition strategy for us going forward to grow exponentially.
Absolutely. So then how did COVID impact Crescendo? I mean, you did a big corporate event, uplisting to NASDAQ in 2020. I mean, that on its own, that's a big deal. But, in terms of COVID, love to understand, what some of the issues maybe the company had to deal with. Was there even a tailwind, especially with more work from home strategies, folks realizing like, okay, we need to now update our cloud communications and whatnot. So like to hear your take there.
Yeah, I think if there's a silver lining to the pandemic, it's the fact that it highlighted the fact that businesses needed to have our type technology. The businesses that were still using the premise-based systems suffered through COVID. They didn't have work from home, so they told their employees, go home and use your cell phone. Well, when they go home and they use their cell phone, they can't put a call on hold on their cell phone. They can't transfer a call from their cell phone. They don't have any control over seeing the reports on if people are even using their cell phone. So for us, COVID actually was a silver lining, the fact that it highlighted the need for businesses to have remote capabilities, have reporting capabilities. One of the biggest things that I think we sold throughout the pandemic was that with our solution, Mr. Customer, you've got 25 employees and you just sent all 25 employees home and you told them to start using their cell phones. How do you know if they're even working? How do you know if they're making phone calls and receiving phone calls? You got your main number that comes in to an auto attendant. Somebody's got to answer it. It doesn't go to their cell phone. So we highlighted the fact that, hey, with our system, give everybody a desk phone, have them plug it in at their house into their cable modem. We get reports off of that. You can see how many calls they're making. You can get your contact center working the way it was in your office. So we really allowed businesses to operate remotely as if everybody was still in the office. I still had supervisors that could monitor phone calls and get reports at the end of the day to find out, hey, Robert didn't make any phone calls today. Hey, Robert, how come you didn't make any phone calls today? Were you watching Oprah or were you doing your job? So it really allowed us to help businesses.
Oprah. That's an old reference right there.
I work during the day, so I don't even know what's on. So, but it's really giving them the tools they needed to work through the pandemic and work in a new environment. The work from anywhere environment was pretty drastic as far as the change goes. If we think about pre-pandemic, only 10-15% of people worked remotely pre-pandemic. At the height of the pandemic, that was 75-80% of the people were working remotely. That number has come down to the 30-40% range. I don't know if it'll ever get back down into the teens again, but that really highlighted for businesses that, hey, I've got to have ways for my people to be part of a communication system and not be out there on their own on their cell phone, especially when you think about employees now with job changes and people leaving. Last thing I want to do is have one of my biggest customers calling people directly on their cell phone as opposed to calling into my business and having it get transferred to their company number or their company extension. Because when they're coming into my company number, I have control of that number. When they're going to somebody's personal cell phone number, I don't have control of that. So if my best salesperson leaves my company today and goes to work for the competition, and all of my customers were used to calling him on a cell phone, guess what? They're calling him at the competition, and I'm missing those phone calls. I don't even know about those phone calls. So we really highlight that with businesses, that having the cloud communications allows you to have control of your communications as opposed to everybody just willy-nilly, as a lot of businesses had to do with COVID. One last item there, Robert, is that we also have a collaboration tool very similar to Zoom that we use. That's our video collaboration, our text capabilities. So we add all of that into our platform. So when we talk to businesses out there now, texting from a business was non-existent 3 years ago. And now it's something that, is more and more critical. So as we think about the generational change, getting a text message from an individual as opposed to a company, now getting businesses to text to their customers, is more and more critical. And that's part of our business. And so is the collaboration. So, instead of paying big dollars for Zoom, we've got that as a free offering as part of our offering with the Crescendo platform.
So another question I have, and this one I've been thinking about a while when I've done a number of interviews with UCaaS companies and communications providers. Is one of the downside risks is the perception that it's now this commoditized thing, or how do you think about that? I'm very curious.
Yeah, I mean, it's when you think about business communications today, as much as I'd like to say we're unique in our offering, we're not unique in our offering. I mean, our platform today, I might have 95 features and RingCentral's got 96 and 8x8's got 94. And the reality is that most end users use 5 of them. So it's not as if it's a feature war. And so, it's really giving them the service and support. And so is it a commodity? It depends on how you classify a commodity, but it's nothing unique. I mean, Crescendo's offering today is a fantastic offering. I think we have all the competitive variances that we just talked about, how we separate ourselves from the competition. But we're not going into a business and saying, hey, we've got something unique that nobody else has. But we are going to businesses that, again, have a premise-based system and saying, what you have doesn't work. And it's not what's going to be existent 5 years from now. So you have to move to the cloud at some point in time. Why not do it now? And here's the platform to do it with.
Gotcha. So what would you say investors maybe misunderstand about Crescendo or still get confused when, maybe they just spent a half hour with me and you, just like we are right now, or seen your presentation or heard an interview you did with Maj or something like that. What do investors still misunderstand or get confused about the company?
Yeah, two things. One, we're not that household name, so they have to do a little diligence to find out, hey, where do we even sit in the industry? So if you look at the UCaaS industry, it was a high riser during COVID, and all the UCaaS stocks were at the top of their valuations. And with COVID being hopefully in the rearview mirror, now all of the SaaS stocks and as a service stocks have really come back down to much more true valuations. We really think that ours, unfortunately, has been seeing a lot of that downward pressure that you've seen on the Zooms and the RingCentrals and the Five9s of the world. And so, we think that we're completely undervalued. But our biggest challenge is just getting the message out to shareholders to have them realize, who we are, what we're doing, and what we're capable of. So, prior to the acquisition, we were probably one of the only, if not the only, GAAP profitable UCaaS companies out there. Now at $16 million in 2020 and $6.5–7 million worth of profit. Now that had some tax benefits in there, but still adjusted EBITDA was almost $2 million in 2020. That was a big statement to go out there and say, hey, we're one of the few GAAP profitable companies out there. Now with acquisition costs and amortization costs through the acquisition, we're focused on our non-GAAP numbers, but still extremely strong non-GAAP numbers because we know how to run a business. We've built this business to grow very profitably and very successfully. So, for investors, when they look at the fundamentals, and I think with all of the shift in the markets over the last year or so, it's coming back down to fundamentals, and our fundamentals are strong as can be. Basically, no debt. The only debt we've got is the building that we reside here in Phoenix. So that's the only debt we've got on our balance sheet. Cash flow positive, adjusted EBITDA positive, organic growth. We've got all of the right metrics for businesses to look at and say, wow, this is a strong opportunity. Plus, at the end of last quarter, we announced the dividend. So, probably the only UCaaS company providing a dividend out there. That's just how confident we feel in our stock and our capabilities to continue to grow the business with positive cash flow. Is that we're trying to set ourselves apart to say, if you're looking for the next big thing, Crescendo is going to take off, because again, that $36 million run rate with the right acquisitions and organic growth, at $100 million in a couple of years, that's a pretty significant growth trend for us to be able to talk about.
So how much, if at all, have your shareholders or potential shareholders influence some of your decision-making process?
Yeah, as a publicly held company, everything that we do is for the benefit of our shareholders. So as we look at how we're growing out there and what our strategy is and what we're trying to accomplish out there, it's all with the shareholders in mind. So, we've met all of our commitments over the years. We told our shareholders when we were on the OTC that we were going to do an organic uplist. We told them we were going to get to GAAP profitability. We told them we were going to go out and do a capital raise. We told them we were going to go out and do an acquisition. And we did all of those with the headwinds of COVID happening. So, in 2020, not only did we do the organic uplist, but we had a successful S1 offering. We raised enough capital to go out and do our acquisition that we completed in 2021 with NetSapiens. And so everything that we've committed to our shareholders, we've come through on. And so I do a lot of investor conferences, and so when we meet with these folks, we're telling them, hey, here's what we told you we were going to do. And every single step along the way, we've met those commitments. And so our commitment is that we're going to continue to grow organically and inorganically. And so our shareholders know that that's what our game plan is. Again, I think our biggest challenge is finding more shareholders. If you look at our stock today, not a lot of float on our stock, not a lot of trading on our stock. So, I think we average 40,000 shares trading in a day. That's not a big transactional type stock. And so, it's really getting the message out there, because, once people see what the company is capable of, I think this is at least a double or a triple bagger going down the line if we look at what we can do if we execute.
For sure. So in your opinion, I asked you about one potential downside risk, but, just playing devil's advocate here, what would you say are some of the company's downside risks?
Yeah, from our perspective, we've got the opportunity to grow. When you look at acquisitions are always, a challenge to integrate. We've had 10 months under our belt now integrating the NetSapiens acquisition. That's gone extremely smooth. We've seen the good cost synergies, but every acquisition comes with, the challenges. And so, we're a small organization. So for us to go out and do acquisitions, we don't have, an acquisition team. So I wear the IR hat, I wear the negotiator hat, I wear the COO hat. So, if we go out and we do another acquisition, it's our team that blends them in. So our CFO, Ron Vincent, that does a lot of the investor conferences with me, him and his team are phenomenal. But, when we look at buying smaller companies that don't have, GAAP financials, getting all of that into one reporting system takes a lot of time and effort. So, I'd love to be able to do 3 or 4 acquisitions a year. We just don't have the bandwidth to do that now. Now, over time, as we continue to grow, maybe that becomes a lot more cookie cutter for us. But, that's probably our biggest challenge right now, is finding the right acquisitions and integrating them into the organization. But, I just go back to our track record that at our previous company, we did over 50 acquisitions over the course of 15 years. And that grew the company to a $500 million run rate and was extremely profitable and extremely successful. So again, it's not our first rodeo. So we know what we're looking for in an acquisition, and we've got a good tight integration strategy. So, although it's a downside risk whenever you're going out there and doing those acquisitions, I think we've got the right game plan to make sure that it's successful for us. And then the only other challenge we've got is obviously, capital. We're we're always aware of dilution for our shareholders and capital expense. And so, we've got, a strong balance sheet today. At the end of the year at 2021, we had over $7 million cash on the balance sheet. We don't want to use all of that in acquisitions. So as we look at potential acquisitions, we've got to be cognizant of, what we can bite off of today without going out and raising a lot of debt, because we're very cautious on going out there and getting too leveraged out there. That's the downside of a lot of businesses. We're going to continue to run our game plan successfully, but if you look at some of the competitors out there, like the Fusions and the GTTs of the world that are in our industry, they went out and bought off a lot more than they could chew, and it put them all into bankruptcy. That'll never happen with Crescendo. So we're very strategic about how we're going to continue to grow. And when we look at some of these companies that went out there and just got way too leveraged and tried to buy everything and just put a big hodgepodge together, it was a train wreck for them.
Absolutely. So where do you see the company in 3 to 5 years, and what, in your opinion, are the inflection points that need to happen in order to get you there?
Yeah. So again, from a growth perspective, organic growth of 20 to 30%, I think that's definitely doable from our perspective, especially where the market is today, with still a tremendous amount of growth opportunity. And then with acquisitions layered in there, I would love to see us at $100 million run rate in 2 to 3 years. Is that doable? With the right acquisitions and the right execution, absolutely. And so that gets us that growth target that we can get on more people's radar screens. As a small $36 million run rate company today, a lot of institutions, a lot of investors look at us and say, oh, yeah, they're a little too small for me. But as soon as we start getting a little bit more girth to us, then we're going to be a force to be reckoned with. So where I look at us in 3 to 5 years is continuing to execute on our game plan. We're not going to veer off and go out and buy something that's not conducive to us. So if we buy from our fishing pond or fish in our fishing pond, that's a home run strategy for us. It worked for us previously, and it'll work for us here again, because it's a very synergistic strategy. From a stock perspective, obviously, again, we feel like our stock is completely undervalued. Steve is our CEO, and he's been buying on the open market. In fact, the majority of the stock that he owns today, he owns 46% of the outstanding shares today. And most of that he's bought on the open market. And he was buying on the open market until this most recent quiet period. So, Steve is a big believer in the company, as we all are. If you look at our insider transactions, most of the executive officers have been purchasing when we're not in a quiet period, because we feel like the stock is completely undervalued, and we know what we've got the opportunity to deliver. So if we think about where we're trading at today from a valuation perspective, if we execute and we get to that $100 million range in revenue, and we can get to a 4 or 5 times multiple, which is very realistic in our industry, that's a tremendous uptick for us. So
to close us out here today, I like to ask this question to everybody at the very end, and it's unique to you because you've been in public markets and been on a public company management team now, even prior to Crescendo. So what's been, I'll re-ask it like this, what's been your experience going from maybe some of those the larger company that you were public company management team on, to now in our beautiful, amazing, wonderful MicroCap land?
Yeah, it's a good question, and to answer it, I'll highlight that at Intertel, being a $500 million company, you got a lot more recognition, and this was back in 2006, 2007, 2008. So that was back at a time when the market was not as overflowing with publicly held options. So it was a whole different ballgame. When I go out there today and I see all these SPACs and I see all these options out there with companies that are trying to go public or are public, it's a whole different ballgame. And so when I think about what it takes to run a publicly held company today, it's knowing that, hey, our shareholders are first and foremost, and we're going to continue to execute to the benefit of our shareholders. I'm not sure a lot of public CEOs still think that way, but it's first and foremost for Steve. I mean, he is our largest shareholder, so he thinks along those lines every single day, because he is the largest shareholder of Crescendo. So when he says it's in the best interest of the shareholders, he's got the biggest portion of that when he makes that statement. But I think for us, it's always about, what can we do to increase the valuation of the organization? And for us today, it's getting the message out there on who Crescendo is. It's executing on our game plan. We haven't veered off that game plan in the 8 years. I mean, when you look at our financials from 5, 6, 7 years ago, we were hemorrhaging money and our revenue was a lot smaller than what it is today. But we kept that same message to our shareholders that, hey, we're not profitable. We're going to get to profitability. We're growing at this rate, and every single thing that we committed to, we've come through on. So as I look at being a publicly held company, there's days when I wish we weren't a publicly held company because of all the rules and regulations and SEC requirements that you've got to follow. We could be a lot more profitable as not being a publicly held company, but we are public and we like being public and we'll continue to grow and leverage that. I think being public allows us to use our stock as equity in some of these acquisitions going forward. So that gives us a huge opportunity to take some of these businesses and show them that, hey, if they come on board and they see that we can execute, the value of their company could go up exponentially. If they're going out and they're selling, just to use easy math, if they've got a $5 million UCaaS service provider company today, and I go in and I buy them for 1.5 times revenue at $7.5 million, and I do a portion of that in stock, and that stock grows, threefold in the next year because we continue to execute. There's $7.5 million, maybe a $10 or $12 million acquisition, and with the valuation of their stock going up. So, that's the message that we tell all of these potential acquisitions is that, hey, if you look at where we are today, this is a growth strategy that's going to continue to grow. And if they take advantage of it now, they're getting in on the ground floor of something that's going to be pretty sensational.
I lied. I usually that's my last question, but I have to ask on the acquisition side of things. From what you can tell us, I mean, how many do you expect to do this year?
Yeah, I think that obviously I can't give you any guarantees on that, but
sure.
I would think that we'll be able to at least hopefully get at least one acquisition done this year. When we talk about that base of 200 customers out there, ever since we did the acquisition of NetSapiens, those 200 resellers out there, they've been knocking on our door saying, hey, when you're ready to talk, we're ready to listen. So, we've got plenty of options out there. It's a matter of picking the right options and executing. And so, again, executing and doing the synergy, that's the key point. So, can we get one done this year? Absolutely. Can we get more than one done this year? Depends on how large and how easily the first one goes. But, our goal is to do, potentially 1 to 2 per year and roll those up. So I think it's definitely something that this year, we're planning on having something done. But, again, the markets and the negotiations will take care of that. But, we've got enough irons in the fire to know that if one doesn't work, we've got plenty of other options out there.
Very good. Well, Doug, with that, where can our audience go and find more information on Crescendo?
Yeah, so obviously our website, www.crescendo.com. Little unique spelling, so CREXENDO.com. We've got a lot of investor stuff on our investor page there. And we continue to do presentations like this. So, Robert, really appreciate you having us on your show and look forward to any future correspondence. And if anybody wants to reach out to me directly, I'm easily accessible and I handle most of the IR for the company today. So my email address is dgaylor, and that's GAYLOR @Crescendo, CREXENDO.com. And look forward to talking to anybody that feels like reaching out to find out a little bit more about Crescendo.
Very good. Well, Doug, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thanks, Robert. Really appreciate it.
Thank you.
Take care.
This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.